And you mentioned the QE unwinding. Where do you expect to see the impact from that? Because this is an unprecedented thing that we haven't seen in the markets. Where do you expect to see that?
So I think there's still far more questions than answers about QE. Clearly it's going to accelerate as we go into 2018. That means more Treasury and more MBS sales. So the question is, will that materially impact interest rates or spreads on mortgages? I think there'll be pressure on both, but there may also be a secondary impact, which is that as banks' reserves that are currently on the Fed's balance sheet are unwound as well, that may pressure them to reduce some of their credit exposure as well. So there may be also, as I said, a secondary impact on credit spreads going a little bit wider.
And when you look at the bond and equity markets right now, what information are you getting from them? What do they agree on and what do they disagree on?
So I think there's a little bit of a disconnect. If you think about the S&P 500 up 15% this year, based on much better economic prospects and higher earnings, you would assume that that would put pressure on interest rates, but rather longer-term interest rates are actually down this year. And what I would argue is that as you think about the Trump agenda, the equity market, I think, is embracing the former positive Trump agenda, which is less regulation, tax cuts, and infrastructure spending. Whereas I think the bond market's a little more mixed. I think they're also concerned about immigration policies and trade policies, and maybe the equity market's feeling a little more sanguine about those too.
Is the bond market more global in that sense?
Clearly. As rates are very, very low in Europe and also in Asia, that's obviously attracting a lot of overseas demand for our market. As you think about developed markets around the globe, U.S. rates are among the highest. We also have a very liquid currency as well, so we've had a lot of interest in our rates from overseas buyers.
And corporate credit spreads are very tight. Bond volatility is really low. What do you expect? What could cause either of those to widen or increase?
So normally credit spreads widen on recessions. However, if you think about the past 8 years, we haven't had a recession, but we've had a number of periods with credits widening, whether it was the European banking crisis in 2011, the taper tantrum in 13, or the most recent commodity debacle in 15 and 16, all led to much wider credit spreads. I think they're priced to perfection today, so even without a recession, in my opinion, I think they could be wider a year from now.
What is the one thing you think people get wrong about fixed income markets right now?
The one thing they've gotten wrong for 8 years in a row is the expectation that rates are going to be a lot higher a year from now. I mean, I think after 8 years, we've proven that there are a lot of, let's say, demographic headwinds to higher rates. Folks are getting older. Structurally, they want more fixed income in their portfolios. So I think people need to stop considering that sort of draconian 200 to 300 basis point increase in rates and assume rates are going to remain fairly low for a very long period of time.